date review. Okay, so we're going to breeze through this. We were doing problem 4-10. Yes? Okay, so we're going to refresh our memories on this. And I have people here in my other section who we didn't start problem 4-10. So we're going to go back on it. Do you have it in front of you? What we started with last class? Yes? No? Okay. So we had a story where we had acquired it January 1st, 2012. And we had done the consideration transfer, remember us? What price? Hopefully this is easy. $137,200. Now, since we're using this as a review class, okay, did you notice the problems in chapter 4 and even 3 don't get really fancy on the consideration transfer? They tend to be just straight cash, right? But where did we get fancy with the consideration transfer? Chapter 2, right? Because there you had things like, not only did you give cash, but sometimes you gave an asset, sometimes you gave shares. Okay, so again, because these chapters are focusing more on the consolidation after, but I expect that you can do a consideration transfer that includes things other than just cash, right? Okay, and we remember that it has to be at the fair value. And then we had the net assets received. The book value was 117. We had our fair values of inventory. Inventory, which was 6,000 times, what's the tax rate? 0.4, 2,400. And you also understand that this could easily be negative, right? It was a fair value decrease. It goes on the same list, but it goes as a negative. Then we had the motor vehicles of 1,000 times 0.6. So this should have been 3,600. 3,600. We had the furniture and fixtures of 8,000 times 0.6. And we had the land of 6,000 times 0.6, 3,600. Okay? And that gave us how much goodwill? 7,500? 7,600 of goodwill. Okay. Now, again, let's refresh our memories from chapter, I guess, 2 or 3 we have to go back to again. Remember that there could have been other identifiable assets or liabilities, right? There could be things that were not actually on the balance sheet. Remember? Things like research and development. What else? Contingent liabilities. Patents. Okay. It's very possible, customer lists, contracts, it's very possible that there's other assets or liabilities that were not actually on the balance sheet. Everybody gets that and we're okay with that? Okay. It goes on the same list. Then let's recreate our table. Somebody give it to me. I had net income, I had retained earnings, and I had the balance sheet. My inventory, we're getting good at this. How many years have gone by? Let's be clear. 2 years, correct? Inventory always sold in the first year, yes, unless told otherwise. So we know that the inventory went to retained earnings. Yes? Plus or minus? Minus. Then we had the motor vehicles. Do you remember in this problem, what was the twist on the motor vehicles? I think it was the motor vehicles.
They were sold?
Yeah. Normally, this is a depreciable asset, but this depreciable asset was sold when? This year. So you have to be careful, because normally we would have realized this fair value adjustment over the life of the motor vehicle. But because it's now all been sold, the entire fair value adjustment comes into income now. So do you recall? We had two effects. We had either the depreciation or the gain or loss on the sale, right? Remember, we had 1 year of depreciation that went by last year. So we had to affect retained earnings. And that depreciation net of tax was 150. Then we had a half a year's depreciation. Why was it a half a year? Because it was sold June 30th, right? If it had been sold December, then you would have had more than half a year, okay? So how much was half a year gross?
125.
125. Okay. And this increased or reduced income? It reduced income. Okay. And that created an income tax effect, correct? Of how much? 50. Then we got to June 30th. We now had to remove the rest of it. Okay? We had to eliminate the rest of it. So we had to know how much was still there. How much was still there? We took the original amount and deducted 1.5 years. And that gave us how much remaining? Because it was originally 1,000. Yes? Notice I'm not doing it net of tax. Be very careful, because you're going to make a common error if you use this number, because this number is net of tax. You don't want the net of tax amount. So how much is left?
625.
625. So we wrote off the balance of the 625, and that also created a tax impact, and that tax impact was 250. And we therefore had no balance sheet impact, right? Because if you sold it, there can't possibly be anything on the balance sheet. And then we had, what else we had? We had furniture and fixtures. Let me put it in here. Furniture and fixtures. And that one was still there. And that one had a remaining life of how many years? 8. So we simply divided by 8. Okay. 1 year went to beginning retained earnings. And that was how much? 600? 600. 1 year went to the income statement, which is how much? 1,000. And that created a tax impact of 400. Right? And was there anything left on the balance sheet?
Yeah.
Has to be 6 years, right? Okay, so 6 years would have been
6,000.
how much?
6,000.
600 or
1,000.
6,000? 6,000. And that would create a future income tax liability of 25. Then we had land. And the land was how much? Did it get sold? Did anything happen to the land?
So,
It was sold. And it was sold in?
last year.
It was sold in 2012. So where's it going? Retained earnings. Okay. Plus or minus? Minus 3,600. And
Goodwill.
what do I have finally? I have goodwill, which we had no impairments, I believe. So my goodwill balance on the balance sheet was 7,600. And I believe that's where we stopped, right? So what we had to do is we had to total these. Has anybody done that? Okay, what do you get?
So for the balance, we have 11,200.
11,200.
Retained earnings, 7,950.
Negative, right?
Yep.
Okay.
And 1,050 for net account negative.
And again, if we wanted to make sure it works, these together should total what?
0.
No?
The difference of the,
It should total the difference between this and this. Or another way to say it, it should total this and this. Do we understand that? Because that's what I'm trying to allocate. Okay. So remember, this is a debit. A negative to retained earnings is also a debit. And a negative to the income statement is also a debit. So in this case, I would add all three. And I don't know what that gives you. Okay. 20,200. Okay. And I want to check that that's the difference between these two, which I can see right away. It is 20,200. So I know that I've done all this correctly and that they're going in the right direction. It's a good way to spot if you went minus instead of a plus. Okay. Now, are you comfortable with this? Are you getting relatively quick with this? There's a problem in the chapter that everybody always asks me the question about. I don't know if you've come across it yet. But it's a problem where you bought a company that already had goodwill. Okay? So you remember from chapter 2 or 3 that when you already have goodwill, we included their goodwill that they already had as a negative in this acquisition analysis. Do you remember that? Yes? So when you do the table, where does it go? Has to go. I understand. It has to go or I won't balance.
Aren't you supposed to deduct it from your fair value adjustments?
I did. Let's say there was one here. And I had goodwill and it went minus 2,000. Okay? Don't write this somewhere because it's not going to work. Where does this go?
On the balance sheet?
On the balance sheet.
So it
Over
would be
here, instead of just
5,000.
being 7,600, it would be 7,600 minus 2,000. Right? Because you have to keep adjusting for it. Does everybody get that? So I don't want you to get confused that it's called goodwill. It's just another fair value adjustment. Okay? That's all it is. But where the problem gets tricky, the one in the book, is tell me if this rings a bell. The problem tells you that the subsidiary impaired their goodwill. Did anybody do this problem? And did you get it?
oops, it added in the income.
Yeah, and you're saying why? Okay.
Confused.
Everybody asks me that, so I'm cutting it off before somebody starts to ask me the question, okay? Why, what is happening? Because think about it, if a company impairs an asset that you put a fair value to, if you put a fair value and then they impair that asset, in substance, that fair value is now realized. You're not getting this. Let's say when I bought your business, I thought the building was worth 2,000 less than you have it on your books. Following me? So I have a fair value decrease of 2,000. I paid less for your business because the building was worth 2,000 less. We're all okay with that? I go minus 2,000 on the balance sheet. I reduce the asset 2,000. But the following year, the subsidiary impairs the asset. And they themselves realize that this asset has no fair value. It's not worth this. It's really worth 2,000 less. So they impair the asset. They, on their own income statement, are going to have an impairment of asset of 2,000. Do you agree? But from my perspective, there's no impairment. Why? I already impaired it when I bought the business. I didn't pay for it. Because for me, I already fair valued it. So from a consolidated perspective, in effect, the fair value adjustment has now become realized. I don't have to make that adjustment on consolidation anymore because now the sub itself has written down that asset by 2,000. So now follow through with me. When I realize a fair value decrease, what happens to my statement? I'm now now the fair value decrease of 2,000 is actually happening.
So there's no adjustment.
There's no balance sheet adjustment anymore, but remember, doesn't it have to go somewhere? It's going to go to net income this year because it happened this year. So on my income, I'm going to have to remove, what account am I adjusting? The impairment account. Because on S's books, there is an impairment of fixed asset. So I'm going to reduce the impairment account, which is going to do what to net income? It's going to go up. And isn't that exactly what happens when you recognize a fair value decrease? Income goes up. And the problem in the textbook is the same one, except it's with goodwill. Because I impaired that goodwill when I bought it. I wrote off that full 2,000 when I bought your business. Now you've gone and impaired it 1,500. So therefore, I only need 500 now. And so the 1,500, since it happened this year, is recognized in income and increases my income this year. Does that make any more sense? I guess the point I want to make is realization doesn't just happen with a sale. It will happen if the subsidiary now impairs the asset that you already impaired. That's the same way. Or another one that's hard in your book, I'm trying to do the hard ones so that you find everything else easy. If you settle a contingency and you settle it for a different amount, remember, it doesn't matter what you settle it for. It's totally irrelevant. Always remember that. All that matters is that whatever you settled it for, it should be different by whatever you originally set up. And the fact that it's settled means that that fair value adjustment has now become realized. That's all you have to know. Okay? And therefore, you have to adjust the fair value. Is that okay? Because I'm repeating it because a lot of that stuff is more in chapter 2 and 3. And I don't want you to forget it as we went into chapter 4 now, in terms of those. So those are the hard ones that typically show up. Okay, so now from here, what are the adjustments I would make? Okay, I'm going to reduce the investment account. How much? 137. 200. Okay, what else? Okay. Reduce share capital. 80,000. Reduce retained earnings. 87. 37. Everybody okay with this? This is the pre-acquisition elimination, right? Now, do the ones for the table. Reduce beginning retained earnings. I should have put beginning here too. Reduce beginning retained earnings for $79.50, which is this. Okay. What else?
Increase furniture by 6,000.
Sorry, I didn't hear you.
Increase furniture by 6,000.
Increase furniture and fixtures 6,000. What's that?
Increase the future income tax liability 2,400.
400. Create goodwill of 7,600. What else?
Increase depreciation expense of Yeah,
125.
Yeah, there's another 1,000, so, but,
Okay, 1,125. I like that. Let's group them. Okay, what else?
reduce the gain on sale.
Okay, or increase the loss.
Yeah.
So let's go with the, because we don't know what it is. So we'll reduce the gain by
625,
625.
and then reduce the income tax expense
Reduce income tax expense
for
by
700.
700, which is these three together. How's that? Find this easy? Is everybody okay with this? Are you fast? Okay, because you should be able to move through this quite quickly. Okay, okay, so next, what do we have? We have intra-group transfers. What do we know in this story? We have an inventory one. What does the inventory one look like? It says intra-group transfers of inventory consisted of, in 2012, sales from Tilford to Sifton, profit in inventory 200. 2013, sales from Tilford to Sifton, 15,000. Profit on hand includes $50 from the previous period sales, 1,000. Okay, so you want to start with the 2012, okay? Because the 2012 one would be the ones that are realized? Yes? No?
Well,
Say again?
So it'll be like the 200, and
200
we'll
left.
have to reduce it from
Okay, so I'm going to reduce beginning retained earnings. Okay, by how much?
120.
Okay, why 120?
Net of
Net of tax, right? So it's gonna be 200 times 0.6, 120. Okay, what else?
the cost of gross sales,
Up or down?
down.
Okay, we're gonna reduce cost of goods sold by
200.
200. And
Tax
increase income tax expense by 8.
But in 2013, it says that there's $50 profit from last period sale.
And so,
isn't there $50 there that isn't realized yet?
okay, and so,
So increase cost of goods sold 50.
okay, we could do that, or, totally right. In 2013, what are you gonna adjust cost of goods sold for?
1,000.
No, in your way, you better not do 1,000, you better just do 950. Because if you, understand, if you reduce this 150, then reduce the next one by 50. Because otherwise you'll be double counting.
Okay.
Do you understand what I'm saying? But I think it's easier to just ignore the fact, like it's kind of like a misleading piece of information in that bracket, because it's kind of irrelevant to me whether or not the inventory came from the previous year or not. Because if I just make the assumption everything's realized, then I'm just gonna make it unrealized again. They're both going into cost of goods sold. So why can't I just adjust cost of goods sold for the 1,000? You're not understanding what I'm saying.
What if you realize, you assume that 150 was realized in 2012, and then 50 was realized in 2013? That's the way I understood it.
I think it says that
Say again?
The way I understood it was 150 was realized in 2012, and 50 was realized in 2013.
No, because read the thing. It says, in 2012, there's profit in inventory on hand of 200. So at the end of 2012, there was clearly an unrealized profit profit of 200, okay? But then it says, at the end of 2013, there was an unrealized profit still of 1,000. What they're telling you is the 200 did not all get realized in 2013. There is still 50 that is still unrealized. So what she was proposing is that I really shouldn't decrease cost of goods sold 200, I should really only decrease it for 150. I have no problem with that, that's correct. Maybe I could write it like that. Or, and then this is not 80, this is going to be 60, okay? But be careful, because if you do this, okay, now tell me about the 2013 adjustment.
Increase cost of goods sold of 950
Okay.
instead of 1,000.
Now, well, do it this way first. If I did this, I'm gonna increase cost of goods sold by 1,000. And I'm gonna reduce income tax expense by 400. Right? This is the unrealized profit. But if you had done her original suggestion, my point is, this adjustment would not have been for 1,000, this adjustment would have been for 950. Because you've already taken into account that the 50 was not realized. Do you see that mathematically they're coming to the same place? You're still sort of staring. Do you see that it's the same thing? Minus 200 plus 1,000 is how much? 800. Okay. Minus 150 plus 950 is 800. Either way, the net effect to cost of goods sold is for the 800, which is the difference that was actually unrealized this year. So it doesn't matter which one you do. What's 40% of 950?
380.
380? 380. But we're missing another adjustment here. What's the other adjustment? Right, I have to eliminate the sales, which are how much?
15,000.
15,000. And what else do I have to eliminate? Cost of goods sold, which is also for 50. Is that okay?
Do we not adjusting inventory as well?
Okay. What's that entry?
We decreased it by 1,000.
We're going to decrease ending inventory for 1,000. And I'm going to have a future income tax asset of 400. Anything else?
Could you do the net cost of goods sold if you just calculate it, and do your 200, 15,000
Sure.
minus 1,000?
Sure.
That seems off.
It's, I'm doing it the longest way possible, okay? To make sure that you see all the steps. But if you see it faster, sure, it's perfectly okay. Next, what do we have? We have furniture and fixtures. Sifton sold furniture and fixture to Tilford for 8,000. This had originally cost Sifton 12,000 and had a carrying amount at the time of sale of 7,000. Both entities charged depreciation at a rate of 10% per annum on cost. Okay, so remember, with these ones, it's very important to know the date. So when did this happen?
June 30th, 2013.
It happened June 30th, 2013. Okay? And what was the amount of this profit?
1.
Okay, and is that easy enough for everybody to see? Right, you use the carrying value, so it would be 8,000 minus 7,000. So the profit was 1,000. The tax on that profit was 400 for a net of 600. Right? And over what period are we recognizing it?
Half a year,
Okay. But how much per year?
100.
10%?
Yeah.
So times 0.1, it's 100 per year, 40 have 60. So what adjustments do I actually have to have this year? Why beginning retained earnings?
Because there's no appreciation last year.
No. When did the sale happen?
This,
When did it even happen? It only happened in 2013. So there's nothing wrong yet with the beginning retained earnings.
So you reduce your gain on sale?
Okay, so I have to reduce my gain on sale. How much, sorry? 1,000. Right? What am I doing there? She is removing the unrealized profit that happened this year. Okay, and if you remove the unrealized profit, what else happens? You remove your income tax expense of 400. Okay, so that removes the unrealized. Now, did anything become realized this year?
This year.
Half a year. So how do I represent the fact that half a year got realized? Okay. I'm going to reduce my depreciation. How much? 50, because it's only half a year. And if I reduce my depreciation, what else?
Tax expense.
Tax expense will go up by 20. Yes?
You're not increasing depreciation expense?
No, because they've recorded the asset at 8,000, and I believe the asset should still be at 7. So their depreciation is too high. Their depreciation is not too low, it's too high. It's the opposite of the fair values, right? It's the opposite what's going on. Now, what else?
Your equipment?
The equipment, because, what is it?
Furniture.
It's furniture? Okay. It's furniture and fixtures. So what do you have to do with furniture and fixture if there's an unrealized profit?
Decrease for 1,000.
So I have to reduce the furniture and fixture. How much? Well, here it's interesting because I went back to look at the problem. Because in this particular problem, if you look at the balance sheet, does my furniture and fixture show net or does it show with an accumulated depreciation? This one shows with an accumulated depreciation. So I have a gross account for furniture and fixtures. So therefore, where are my adjustments going? So what is my adjustment to furniture and fixtures? The full 1,000, and then what's going to happen? Should I reduce it or increase it? I'm going to reduce my AFDA by AFDA. Wow. My accumulated depreciation, furniture and fixtures, how much? 50. And I want you to be careful here. It's only the same as the depreciation because it's the first year. Normally, it's not going to be the same because the depreciation is adjusted for what happened this year, but the accumulated depreciation is adjusted for all the years. Okay? So be careful. And finally, what else do I have to do? You have a future income tax